Hi everyone, it's Paul Tilley, and welcome back to AC1260 Financial Accounting 1. And today we're looking at Unit 7, which is Internal Control of Cash. Oh my, cash is a challenging subject because the fact of the matter is that a loonie, a toonie, a bill, a 20, a 5, there are so many combinations, and really they're owned by the person who has them. Meaning that if I happen to take $20, it's very difficult to prove where it came from. And if I stole $20, it's very difficult to prove that I took it, the actual $20, that is. So the internal control of cash is very important because what we need to do is to control it in the sense that it doesn't get lost, it doesn't get misplaced, and most importantly, it doesn't get stolen. So in this particular unit, we're going to be looking at what companies do and how accountants manage cash control. First of all, we're going to define and explain the purpose and identify the principles of internal control. We're going to define cash and explain how it's reported. We're going to apply internal control of cash principles. We're going to explain and record petty cash fund transactions, which is important and common in most organizations. We're going to explain and identify banking activities and the control features that they provide business. And we're going to prepare a bank reconciliation, which is an important topic for all students to know how to do. And we're going to journalize the resulting adjustments. We're going to calculate, finally, the quick ratio and explain its use as an indicator of the company's liquidity. So, starting off, why do we have internal control systems? What are the purpose of these things? Well, first of all, generally they tend to be policies. And the policies and the procedures that go with them are designed to protect company assets. So it ensures that the assets stay within the firm. It also ensures reliable accounting, and it promotes efficient operations of the company, and it encourages people who work for the firm to adhere to the company policies. One of the key features that you will find in any business, regardless of how big or whether you're involved in accounting or not, is that there are standard procedures of internal control that all organizations follow. These include establishment and separation of duties on who's responsible for cash and what needs to be done with it. We also ensure transaction activities are authorized. So who has the control over spending? Who has the control over who can take the money? Who has control over what's purchased? How much is purchased? And these sorts of things. The maintenance of records is important. We need to make sure that we have a clear indication of where the money was spent, how much was spent, when it was spent, and that way we can track it. And we're going to ensure assets and bonding is done for key employees. Now, bonding involves and effectively it is an insurance policy on your workers. Okay, it ensures that the workers are above board, meaning that they don't have a criminal record or some sort of past history that would affect their credibility. And it also ensures that the people we have working for us are trustworthy. And that is ultimately one of the key things that business wants to do, is to have trustworthy employees. We're also going to apply technological controls, and these technology controls include things like cash registers, things like computers, things like electronic cash machines and the like. And we're also going to perform internal and external audits, which what companies do in order to ensure that what they say they're doing is actually being done. So internal controls are unique to every business. Certain businesses have more need for it than others, but effectively the basic principles, regardless of the size of the business, retained throughout. Fraud is a big thing in all businesses. We're all concerned about loss. And what do fraud really require for it potentially to happen? Well, first there has to be an opportunity. So if we reduce opportunities for fraud, that will help us protect ourselves. Rationale. Is there a reason people would steal from us? If we set up a company in such a way that people are treated fairly and these sorts of issues with regards to monetary compensation and the like, it removes the rationale for fraud. And it also removes the third item, which is motivation. People will no longer be motivated to steal. So effectively, opportunity, motivation, and rationale are key, and those are the things that impact the possibility of fraud in your business. So what are some key fraud prevention methods? Well, first, we have to reduce processing errors using technology. Being able to use technology is great. Let's say, for example, a bank machine. A bank machine, you go in, you punch the numbers, I want $20. The machine spits out $20. Using that technology ensures that exactly $20 is spit out because the machine has processes in place that are consistent. However, if we went into a bank teller and we look for $20, maybe they're stuck together, maybe the person isn't watching, they get distracted, some sort of thing. So a person is much more possible to make a mistake than the machine. So again, that technology reduces the chance of errors. We also have testing and electronic controls. These are processes in place that ensures that, for example, if we say that a certain amount of money is going to get deposited, exactly that amount of money gets deposited. So things like a management system for our money in terms of a lockbox, but also in terms of computerized accounting software, spreadsheets, these sorts of things allow us to add up money. Adding machines add up money very easily, very quickly, and very efficiently. Limited evidence of processing documents and more focus on design and operation of information systems is also one of the measures. We want to make sure that we have lots of evidence of processing. So, for example, receipts, invoices, these sorts of things. And focusing on design and operation of information systems that work for your business. So what would be the proper process in order to ensure that takes place? And increased e-commerce is important too. You know, for example, if you can avoid the use of actual cash and use electronic processes in order to send money, that would ensure that there's less opportunities for money to go astray. We also have to look at what are some of the limitations of internal control. And like any system, there are limitations to it. Things like human error certainly play into a big problem with internal control. Negligence, fatigue, misjudgment, confusion, distraction, these are all things that lead to human error. But we also have human fraud, which intent is involved in. So in the case of human error, there's no real intent. But fraud implies an intent. Someone set out to defeat internal controls for personal gain. And we've got to make sure that we want to limit that. It costs lots of money to put these processes in place. And we have to make some sort of a balance. So we got to think to ourselves, is the control process that we put in place sufficient to meet the needs without costing so much? So, is there a high cost to the security? Is the cost worth it? And that's a standard question that all businesses will ask. Cash is one of the biggest challenges with regards to internal control because, as I say, it's so easily moved. It has no particular ownership to it, and he who has it can spend it. So it's a very important asset for the company that we need good control of, and we need some sort of a process that ensures that the cash is carefully monitored. So cash includes things like currency, coins, deposit and bank accounts, and other items that are acceptable for deposit and acceptable for transfer. It focuses on the issue of liquidity. Liquidity is a big thing in business. We've talked about inventory and how inventory is relatively liquid, meaning that it can be converted to cash within 1 year. This then is close to cash, and this is another opportunity for fraud. So if you're a business who has inventory on the shelves for sale, sometimes that inventory can disappear. Maybe it's stolen, maybe it's misplaced. But the fact of the matter is fairly close to cash. So like cash control, inventory is important to control as well. And we really had to ask ourselves, what assets do we have that are very liquid, that can be easily converted to cash and can be easily taken out of the business and taken away from the business through fraud or by some other means? So we need to make sure that not only our policy manages cash, but cash equivalents as well. In terms of internal control of cash, there are certain key guidelines. First of all, we got to separate the handling of cash from the record keeping of cash. That's hard to do for really small businesses, but as the business grows, the person who actually counts the cash needs to be different than the person that records it, or a second person should be responsible for the record keeping of it to prove that if there's $100 counted, $100 was recorded. Having two people to do that is a better and safer way. Another thing is that cash is not lying around. It's deposited in a bank account every single day. And that way we can ensure that we can trace when problems happened. Okay? And we need to make cash disbursements as much as possible as by check or some other electronic means, so that there's a clear indication of exactly how much was paid, when it was paid, how it was paid, and to whom it was paid. In terms of receipts for cash, we also need to control them. Internal control over cash receipts ensures that all cash received is properly recorded and properly deposited. These controls would include things like used cash registers, over-the-counter cash sales systems, control of mailed-in cash receipts. So, for example, when cash comes in the mail, it needs to be counted in front of two people. And the separation, again, of record keeping and the custody of the cash. So we need to ensure that we have processes in place that do that sort of thing. In terms of cash disbursements, we need to control them as well. All expenditures should be made by check and recorded as such. So the only exception is for small payments such as petty cash, and we'll talk about that in a few minutes. There needs to be also a separate authorization. So, for example, two signing authorities on a check. So check signing and record keeping duties need to be separated, and more than one person need to sign the checks or have control over the disbursement of the cash. We also have something called a voucher system. And a voucher system is just basically it's a credit system where people can go and spend money and they get a voucher for it, and that voucher then is recorded, and at the end of the month, for example, the vouchers are tallied up and the bills are paid. We also have what's called a three-way match, where the person who approved the purchase order and the person who received the actual product and the person who receives the invoice confirm that indeed that was the product purchased, that was the product received, and the invoice for the product matches the product. In terms of petty cash, sometimes we're doing rather small expenditures that we don't want to write a check for. So the paper person comes in and you owe them $1.50 or $2. It's hard to write a check for $1.50 or $2.50. So what we tend to do is to have a little fund of money in your business called a petty cash. And the petty cash consists of a box, usually a lockbox, that contains an amount of hard money. So in order to manage this money, to make sure it doesn't go away, we need some sort of an internal control procedure. So the petty cash system in and of itself is a control system. So how does it do it? First of all, we need to put money in the container, okay? What do we need in order to do that? Well, we need to actually journalize the fact that we've taken money and we put it in the container. So for example here, the cashier's office prepares the checks to establish a petty cash fund, and that goes to the petty cashier. So in other words, we create a paper trail. And the paper trail here, you can see the journal entry. So petty cash is debited, goes up by $150, and the cash in the bank account comes down by $150. Basically, we took $150 out of the bank, and we put it into that can that we call the petty cash can. So when the petty cashier makes payments from the petty cash fund, a little petty cash receipt is used, such as the one here. So for example, someone comes in and they're delivering a product and it's $5. So what we do is we take $5 out of the petty cash jar and we give it to the person goes on their way. But we need to put in what's called a petty cash receipt there. So we have to figure out what was the petty cash for, delivery charges. It gets charged to the account called delivery expense. It was approved by an individual. Their name is written on it, the date, the amount, and received by. So we see who got the money, who sent the money, and what the money was for, and on the date. In terms of operating a petty cash fund, the process is pretty straightforward. Okay, so we saw originally that we put $150 in the can. Okay, so here's our little can, petty cash can, and as people come in and things get spent, we fill out what's called the petty cash receipt. When the money in the petty cash can is reduced to a really low level, we need to reimburse the can. How do we do that? Well, we create a journal entry based on the petty cash receipts. We pull them out and we say, okay, we spent $46 on postage. We spent $80 on courier. We're going to journalize those as an expense to the appropriate account. So postage expense gets debited and courier expense gets debited for $46 and $80 respectively, and this gets credited to cash. So this would certainly be clearly indicating what the money was spent for. So in terms of operating a petty cash fund, to replenish the cash required to replenish the cash in the can is the difference what was in the fund, $150 let's say, and how much was spent. Sometimes there is money missing or maybe too much money, and we can calculate cash over or cash short by simply looking at the receipts we have and looking at the amount of money that's left in order to figure out how much we spent. In terms of banking activities and controls, banks are very important because what they'll do is they will manage our cash for us, and they keep a record of that cash going in and out. So the basic bank services would include a bank account, bank deposits and checks, electronic funds transfer, credit card transactions, debit card transactions, Interac transactions. In terms of credit card transactions, many companies allow customers to use credit cards for their purchases, and the risk of bad debts is really transferred to the credit card company. So that's the biggest thing with the credit card, is that from a company's point of view, if someone doesn't pay their credit card bill, that has no effect on the company. So that you're paying for that risk protection. So the company collects cash from the sale fairly quickly. The credit card company sends the cash over to the business, and the credit card company charges a fee to the vendor. So you're paying a percentage of your sales. So for example, if someone buys something for $100 on a credit card, usually about 2% or $2 of the 100 goes to the card company. Different cards charge different amounts, so it's not a set amount. Let's take a look at an illustration of a credit card transaction. So Techcom has $100 of credit card sales with 4% fee, and cash is received immediately. So assume the cash sale of $40. So what do we got on the go here? Well, in this case, we went and sold something for $100. Now, sales are credit. The cash came in, it was $96, and the credit card expense was $4. So 96 and 4 are the debit, and the credit is the cash sales. We would also record our inventory going down, so the second entry there would be for our merchandise inventory, which is cost of goods sold, $40, merchandise inventory, $40. Okay. In terms of a debit card transaction, many companies allow customers to use debit cards. That's pretty common today, and bank transfers funds from the customer's account to the vendor's bank account. Simple as that. And the bank charges a fee for that. The entries are identical to the credit card system. There's no difference in it. In terms of Interac Flash, debit cards that allow customers to pay using contactless debit technology. All we're dealing with there is the technology. Really, merchants can service customers more efficiently. There's no cash involved. There's no touching involved, particularly in the days of COVID. This is very important. And it gives all kinds of extra security against skimming and counterfeiting of cards. And obviously the bank charges a fee to vendors for this too, and we record it exactly the same way as it was for the credit card. Okay, so what we're really looking at then is a way to manage the cash and to manage the continuity of that cash within our company. Now, let's assume the end of the month comes and we've done all these transactions and we get our bank statement. Okay, we get our bank statement, and our bank statement shows all the money we put in and all the money we took out and our ending balance. We need to reconcile what the bank says we did versus what our record system says we did. And this is what's called bank reconciliations. So bank reconciliations are prepared periodically to explain the difference between cash reported on the bank statement and the cash balance in the company's books. And it is a very important element of internal control that all companies should do. Here we have an example to show you this. So let's assume that the bank statement comes. So here's a bank statement for National Bank, Hamilton, Ontario, for our company. And it says that the balance was $1,609.58 at the beginning. We had $723 worth of checks and debits that went through, and we had total deposits of $1,163.42. So the current balance in the bank account is $2,050. That's just a summary. The detail is hammered out down below, and you can see, for example, through the month of October, the ins and outs of credits and debits. Okay? So you can see that. So that bank statement is right there. We're looking at it. And we have to compare it with our general ledger. The general ledger cash receipts and cash disbursements journals provide information about everything that has gone on through our accounting records for a given period of time. So if we look at our cash receipts journal, for example, we can see for the month of October, the various deposits that were made and the various checks that were put out. So we see that we should have, based on that, a cash balance of $1,404.58. However, the bank statement doesn't say $1,404.58. It says $2,050. So why is the bank statement different than our general ledger account? So this is really what the bank reconciliation is supposed to do. It's supposed to rationalize why there is a difference. So some items are reflected in the bank statement, but are not reflected in the general ledger. And some are reflected in the general ledger and are not reflected in the bank statement. So what we need to do is go through a process to evaluate the two. So what kind of things would get included or excluded? Well, in our bank statement, outstanding checks may or may not be there. Deposits and transits won't be there. And bank errors won't be there. In our general ledger, non-sufficient funds checks, so for stuff that bounced, wouldn't be recorded there. Service charges wouldn't be recorded there. Interest on the bank account wouldn't necessarily be recorded there. Collections made by the bank wouldn't be recorded there. And obviously, errors wouldn't be recorded there. So let's prepare a bank reconciliation for this company at the end of October 31st. So here on the left, I have the bank statement. And on the right, I've got the cash receipts and the cash disbursements journal. And what we need to do is to rationalize the two. So what I've done here is blocked off in the orange. So these items appear in both the cash receipts journal and the bank statement journal. So that you can see the orange coded are the ones that occur in both. Things that are not highlighted are unique. So we need to think about the unique ones and see if we can rationalize it. So if we look at our bank statement, these items appear on both the cash disbursements journal and the bank statement. Therefore, none of these items need to be reconciled. They're in both. However, some of these only appear in the cash receipts journal or the cash disbursements journal or the bank statement. Therefore, each of these need to be. And we can see the ones in yellow here are the ones that do not occur on the other statement. So, for example, if it's in the cash disbursements or cash receipts, it is not on the bank statement and vice versa. So the items that show up only on the bank statement are reconciled items on the book side of the bank reconciliation. So what's going on here? Well, let's take a look at it. If we look at this, there was $485, so collection of $500 note less the collection fee. So that actually came in, and the collection fee interest wasn't recorded, so we need to worry about that. And there was a non-sufficient funds check for $30 that got zapped out, and we can see that, and a $10 charge and a $20 not NSF. We didn't know that had happened, so looking at that, we can see, okay, we need to adjust those. We add the collection fee and we subtract off the non-sufficient funds charge off our books. So the items that show up only in the cash receipts and cash disbursements journal are recorded items from the bank side. So we got on December 31st, $145 deposit, and check 124 and 126 haven't gone through yet. So we need to take a look at that. So our bank balance is $20.50. We've got to add in the deposits in transit to that haven't shown up in the bank yet. And we've recorded them in our books, but they haven't shown up in the bank. So we got to add that back in. So that brings the balance up to $2,195. And the outstanding checks that haven't gone through the bank yet were 124 and 126 for $150 and $200 respectively. So we can subtract off them. So the final product then is we can see that we've made the additions to the bank and subtractions from the bank. We've made the additions to the book and the subtractions from the book. Once we've done that, you will know that the adjusted bank balance should be in balance, as indicated right here. Once we make those changes, we just record the fact that these things have been have occurred that would not have shown up in our journal. So, for example, the collection expense would get recorded, cash would get recorded here for $485.15, and the interest income, cash would go up by $842, and the interest income would be reflected as $8.42 in revenue. We'd also record the adjusting interest rates for bank reconciliation, so accounts receivable would be increased because that check bounced for $30, and there was office supplies expense that hadn't been recorded yet, so that would be recorded for $23. After posting reconciliations, the cash account looks like this, and it will balance.